Walk us through earnings season. What's going to happen next?
What's going to happen next? Well, what's happened so far is obviously that we've had a very mixed bag of numbers. We had some strong numbers on the financial side, so that's supported sort of the bank sector. We've had some weaker numbers coming through on the tech side with the likes of eBay. I think what it's helping to do is underscore that sort of that idiosyncratic approach to risk on a name-by-name basis. We've had the trade tariff effect through Alcoa and whatever. So I think while generally the earnings season is providing an optimistic base for the markets generally in terms of sentiment, it's very much on a name-by-name basis. So we'll be watching all the names as they come out during the course of this week, rather than assuming that the tide lifts all ships.
And bringing it right back here to home, I mean, obviously a dollar-based economy, all of these Gulf economies. Walk us through what happens here specifically, given the comments about the Fed, Donald Trump, a lot of questions about what's happening, global growth. But higher oil prices. But higher oil prices, are good for the region, of course, in terms of production, in terms of oil exports. I think generally the outlook for this region is optimistic. We're looking for an improvement in the growth trajectory going into 2019 from what was a low and disappointing and to somewhat extent surprising low growth picture of 2017 through the OPEC oil production cuts. But generally, I think from an economic perspective, we're looking for buoyancy, and from a risk asset perspective, the MENA GCC markets add that element of incremental yield in what is still a low yield environment, as Sri was suggesting earlier on. And we listen to how the data dependency of central banks, keeps those yield curves fairly well anchored. That should enhance the MENA GCC space.
Simon, earnings. They're all robust and they look quite rosy so far, but if this tariff narrative really takes hold, cost pressures are already quite high in corporate America. That could get even worse. This isn't the best backdrop to really consider future earnings, isn't it? So in terms of the forward guidance, it's going to look quite ropey. Is that going to really cause some risk aversion in these markets?
Well, again, you're absolutely spot on, Sri, and I think the key thing is to what extent and to what level of clarity that forward guidance comes through. Yes, the numbers for this quarter may look fairly firm and supportive for general market sentiment, but as we've said, as Christine Lagarde has said, in terms of potential impact on global growth going forward, the impact on earnings could be severe. And we need to really sort of delve into on a name by name basis, the outlook and expectations for growth, not just next quarter, but more importantly through 2019 as tariffs potentially kick in, more meaningfully.
And would you say that the best hedge, if you do feel that the tariff story is going to get worse, not better, is going to be the Russell 2000, those domestic small caps that are relatively insulated from all the machinations related to cross-border trade, etc.?
Yes, no, absolutely, and I think the Russell 2000, as you say, gives you that level of transparency, that level of hedge. And in the UK, if you're trying to sort of go against or trying to hedge against sort of the Brexit risk that Hadley alluded to earlier on, we discussed. Then again, outside of the FTSE 100, because the FTSE 100, of course, or sort of look at the FTSE 100, because the overseas earnings capacity of many of those companies will be benefited by a weaker sterling if sterling continues to depreciate on the back of those Brexit concerns.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.